as per always, we begin with the macro side, and we did have geopolitics as 25%, so it's probably a good place to start right here.
We did. My own bias is to say that I would take the under on that 25%, not because I expect geopolitics to settle down, but because the market has shown and the economy has shown such remarkable resilience in the face of these geopolitical threats. And we've talked about this in past quarters. All the things that the economy has had to withstand, it has withstood. And so you're almost, let's say, either the economy has to be really fragile or geopolitics has to escalate from here in order to derail things. And while those are both possible, I don't think I give it a 25% probability. That's my own bias. And a big example of that is just what we're showing here. 3 months ago, we were in the early stages of the war in Iran. We didn't know very much about how it would play out. We were confident and remained confident that it would push inflation higher, which it certainly has done. We thought there was a risk, but not a high probability that it would be disruptive to growth. And so far it hasn't been. But look, even within that inflation basket, the impact has been contained. It's been, limited. And part of that is that oil prices didn't stay up for very long in the grand scheme of things. Duration matters as much as magnitude when we're talking about this. It's the average price of oil over a longer time horizon that matters, and the average price of gasoline rather than what it is on just any one given day. But what you see is largely that headline inflation has gone up, but that's kind of it. The other measures of inflation that we look at, and we're showing the preferred, trimmed mean measure of inflation. I won't call it the preferred because Chair Warsh has been clear the last couple of days that he doesn't have a preferred measure. We thought this was the one he liked, but he's going to have to tell us. Either way, the point is we're seeing a very narrow, limited impact from this. And again, to the point about geopolitics being manageable from an economic perspective, this is good evidence.
And just as a quick side, just if you could tell everybody what the Fed trimmed mean is and why 24 and 19% matter here?
Yeah, so look, the Fed trimmed, this is not the Federal Reserve Board's official trimmed mean number. A variety of different institutions, including the Dallas Fed, produce different measures of inflation. The one that we've always focused on is a core measure that excludes volatile prices like oil and food, which monetary policy can't do very much about. Demand is inelastic. People have to eat, they have to fill their car. You can't influence that by moving interest rates. So we've excluded those. A trimmed mean methodology takes a slightly different approach, and instead of excluding specific categories, it says, okay, we've got 100 items in the CPI basket. We're going to count the middle 60 or 70 or whatever your number is to exclude things that are outliers, right? To try to get a better sense of what the underlying and nature of inflation is. It's a perfectly valid empirical approach. It doesn't yield results that are really all that different.
Yeah, we'll save that for, we'll do an additional CMO addendum on trimmed mean.
You sure we could spend a whole hour talking about inflation?
That's exactly what I'm afraid of. Moving on. So let's zoom out and talk about the different.
Look, and this gets to the same point, right? You leave the war out, you leave headline oil prices out, you leave gas prices out because they're geopolitically influenced, and what you see is everything else is starting to improve, or most other things are starting to improve, or at the very least, they aren't getting worse. Food prices are largely stable, services prices are stable, goods prices have started to go down again after the worst of the tariff impact has passed through the system. Really what you see in the top right is, we got a spike in energy prices just like you would expect. Nothing else looks very much different. And even in some important categories, you see some signs of improvement. So from our perspective, what that argues, again, is resilience on the inflation front, resilience on the economic front.
Thank you, sir. And
forward-looking, same deal, right? I mean, we've shown this chart on the left repeatedly. There is still more disinflation to come through the shelter component, which is the largest component of inflation. Housing, rent, and things that go along with that tend to respond to house prices with a lag. We're in that lag period now, where past deceleration in house price gains is going to continue to feed through and pull that component a little bit lower. Inflation expectations remain well anchored. Short-term expectations move around with gas prices, but the ones that are important are what people think about over 5 and 10 years, because that's what influences business planning. That's what influences big investment decisions from the household sector as well. Look, we think that in general, the inflation picture looks okay. And if oil prices don't go back up from here, a year from now, we're going to be talking about inflation that is meaningfully lower.
I want to say, by the way, that I know that we know this academically, but the behavior of that 15-month lag really behaving itself and doing exactly what. So for those that haven't seen this in the past, we talked about this years ago during COVID because coincidentally, I think it was the Dallas Fed had a paper out on owner's equivalent rent and so forth, and they were talking about the lag effect. What you're looking at is we've taken those lagged periods and put them on top of each other, and it's incredibly well behaved.
Yeah, look, it's very rare for things to behave quite this well when they are that volatile, but it's an encouraging sign that we're on the right track analytically.
Okay, let me see here. Let's push this forward. And by the way, Jeremy, a right hand on the team who puts together basically all of the project management of the CMO and designs a lot of the macro with Eric and myself. He is color coded in the upper right hand corner. So there's a little bit of a follow along if you'd like. We have an inflation, a labor, and a growth and a rates. And so you can tell by the goal that we've made our way into labor.
Yes, we're into labor. And if I think about the things that have changed the most over the last few months, this is where I would start. We came into this year expecting rate cuts from the Fed, which we no longer expect, and not really because the inflation picture has changed. As I said before, I don't know that it has changed that much, but the labor market picture really has. Over the latter part of last year, the unemployment rate ticked up 6 months in a row. The run rate of hiring was basically zero. I mean, you could see it vacillated around month to month, but was basically zero. But over the course of this year, it has been steadily positive and the unemployment rate has come back down. The labor market has stabilized. I don't think anyone would say it's robust or strong or booming or, pick your adjective there, but it has stabilized, and that has obviated the need for the Fed to raise rates.
And staying with that theme, there's a little bit of a story in the nature of labor over time.
Look, it is the word chaotic there. Look, the labor market we talk about as this unified thing, but it's always, there are different sectors that are going to do better, that are going to do worse. And what you have seen in the post-pandemic period is the sector that's done best by far is healthcare employment. This is a long-term demographic trend as our society ages, and it's not going to change for the foreseeable future. Healthcare employment is a big part of what's going on in the economy. We're monitoring this closely because we want to get a sense of the impact of AI to a large degree. If you look at the headline numbers, you don't see a story where AI is costing jobs in the aggregate. Look under the surface, you see that light-colored yellow line, which has gone down a little bit the last couple of years. That's technology. And if I were to tell a story around AI costing jobs, that's where I would start. It's just that we're seeing it offset by strength elsewhere. So from an aggregate macro perspective, the job losses, if there are, to the extent that there are any from AI, here again, are manageable for an economy that has been resilient.
Speaking of things we could spend another hour talking about.
Yeah.
And so in terms of AI's impact on jobs, everyone. So let's start to bring this home because you just mentioned this outside of healthcare, job growth is.
Yeah, and so this is why I said, no one would look at this labor market and say it's strong, it's booming, whatever. Healthcare is playing a driving role, and that's a fairly inelastic thing. People are all aging, and you can't stop that. So that the hiring needs in healthcare are going to continue. It's useful to look outside of healthcare, and things there look okay. They don't look great. Again, stable is the right word, not strong. What we have seen, though, from the corporate sector in general is that businesses are slowing their rate of hiring, but they're not laying people off, right? Demand is still strong enough for businesses to keep people employed. And again, you get this idea of stability, of stasis, where we're in a low hire, low fire sort of environment. If the business cycle were to turn, then we would expect to see layoffs, and we would see what happens on the other side of that. My guess is that that's where and when you would really see AI have an impact. If businesses are forced into big layoffs, I bet they would be pretty slow to rehire and try to work with AI. But as of now, businesses are not laying people off, with the exception of some tech-specific industries, because of AI. It's just a low churn environment. People have jobs. They aren't necessarily optimistic that they can find a better one, so they're staying where they are. And businesses have employees, and they have enough work to keep them occupied, so they're keeping.
So I think one of the things you'll see as you go through here is, this isn't meant to be a sort of doom and gloom thing. It's the idea that there's an expectation for solidity and growth. But if you're looking for the things that speak to weakened buffers that exist inside, that's what we're talking about.
Yeah, so look, there are, one of the things that has allowed the economy to be so resilient over the past few years has been this idea of a buffer, of excesses that have built up. And for a long time, households had excess savings that allowed them to maintain their level of consumption even as prices spiked post-pandemic. Businesses struggled to find employees, and so there was this residual buffer where they still needed to bring people on board, even if demand slowed a little bit. They did that. It's not clear. In some cases, those buffers are clearly eroded, right? Households don't have excess savings at this point. Businesses don't appear to have pent-up hiring demand. The U6 unemployment rate, which measures underemployment, right? So people who have jobs, but if all else equal, would prefer to have a better job, that's gone up a little bit. And I think that's consistent again with this idea that things are okay, but not boom. In a boom time, people leave jobs because they think they can find a better one.
And so that takes us into our next color-coded section, because as goes labor, so goes consumptive power, as goes consumption, so goes growth.
Yeah, and look, I think we can be pretty quick with this one, right? You can look on the left and in quarter to quarter, GDP growth can be attributed to a variety of different things, as always. On net, it averages out to 2%. I mean, that's just where we've been for the recent past. That's where we expect we're going to stay, is right around 2%. And if you look at the better forward-looking indicators, which we've graphed on the right, they're all pointing to a continued modest expansion.
And there's just this tiny little thing I want to use to jump us into the next slide, which is the last stacked bar chart. If you squint, you'll notice that we've got personal consumption. That's the black. That's a nice, healthy, thick bar for a little while. The most it's only an N of 1, but it's a little thinner. And fixed investment is that green one that's pretty thick. That's right there.
So that tells you what you need to know in two respects. One is that the decrease in personal consumption last quarter was because of higher energy prices. That's households feeling the squeeze, having to put more money in the gas tank and less money elsewhere. The teal, you said?
I was the 8 crayon box guy, so that's great. That's just pretty to me.
Well, at least you can see the screen from action. Whatever color that is, the investment bar, that's the story of the economy right now. That's investment. That is money flowing into AI-related investment, which has been gargantuan.
Thank you. I appreciate you bringing those two little parts of the bar to life. I needed that to happen.
So, look, again, limitations to growth. We can dispense with this fairly quickly. The left side, we're seeing real average hourly wages. They were weak last quarter. Why? Because when we say real, they're corrected for inflation. Inflation went up because of oil prices. Real wages went down. Oil prices are now down quite substantially from where they were at the peak. This number is likely to go back up. Nominal wages have been remarkably steady at around 3.6, 3.7% year over year as the rate of growth. This is about the vacillation in oil prices, not a change in the nature of the labor market. But as I said, the buffer, that irrespective of why it's happened, that has forced households to draw down their savings. And the middle chart shows that the household savings rate fell during the second quarter as people had to save less in order to keep things afloat. That should go back up if oil prices stay where they are, which is, $50, $40 lower than it was a couple months ago. And that's a big boost to household finances.
And the final part on the right-hand side here, we've talked about this a lot, so we won't spend a lot of time, but we've talked about the wealth effect and where most of the consumption is coming from in terms of the top 10% of earners. So back to that idea, just keep an eye on the buffers. That's sort of what we're getting at here. But now, these in the future, because of that quote that is underneath the right-hand dots chart, we may not even create this anymore, but...
So Chair Warsh has said that he is not a fan of the dot plot. He refuses to submit his own dot. I very strongly agree with him. I think the dot plot is close to useless at best and counterproductive at worst. I think there is a time and a place for it, which is when monetary policy is trapped at the zero bound, can't cut rates any further, and the dot plot or forward guidance is really the only way to ease conditions further if you need to. Outside of that, I hope they get rid of the dot plot. I don't think it really adds much to the discussion. But since we have it here, the Fed itself is deeply divided. The members of the committee don't expect to raise rates this year, and half or don't believe that it will be appropriate to raise rates this year, and half of them do believe that it will be appropriate to raise rates this year. How you can expect to give forward guidance for a committee that's divided down the middle is a mystery to me, and that's part of the reason I think that the dots are useless. What I would point to instead is if you look on the left, right, what has changed versus what hasn't. Their estimates for inflation have changed because the price of oil has gone up. But their expectations for everything else, just about, have not changed, right? And the bottom, again, with the dot plot, right, that's the median dot, but it's only moved if one voter changed their vote from up to down, that median dot for the Fed funds rate would be right back where it started. The only thing that's changed in this economy is inflation was temporarily higher.
The dots chart for me has been a source of agita for years because trying to explain the variance in the dots is...
It's a frustration, and I won't go on a lengthy tirade about this, only a short tirade. The problem is that the market persistently misinterprets it, right? The Fed does not intend this as a forecast. This is not a forecast. This is not a pledge. This is not what they even expect to do. It is what they say that they believe will be appropriate, conditioned on the idea that their forecasts come to fruition. So different members will submit different forecasts, and based on their independent forecasts, will submit a dot based on what they think they would do if their own individual forecast came to fruition.
If things work out the way we think they're going to do, then it's going to go like this with the dots.
This is what we think we would do. And the market tends to anchor to these much more than I think the Fed does.
So let's just say the grain of salt doesn't do that chart justice, but let's put it into your words.
Yeah, and so to that point, our base case is for 0 rate hikes. I don't think, based on the idea that the inflation picture is stable and maybe even improving in some cases once you get past the oil shock, I don't think it'll be necessary for the Fed to raise rates. What I will say, though, is I don't think it matters very much. Right? If the Fed raises rates 1 or even 2 times over the next 6 to 9 months, I don't think that would have a meaningful impact on the economy. It overestimates the power of monetary policy to think 1 rate hike really moves the needle very much, especially since the market is already priced for that 1 rate hike, right? So I don't think they'll raise rates. If they do raise rates, then so be it. I don't think it would change any of our other forecasts in a meaningful way.
I think it's dangerous to get into fine-tuning.
It's dangerous to get into fine-tuning.
With a blunt instrument.
Correct. It is a blunt tool. And what would be disruptive isn't the idea that they fine-tune and raise once or twice, which, again, I think would be sort of a silly thing to do. But if they conclude that they really and truly need to re-embark on a tightening cycle in order to bring inflation down or to slow growth, that's a very different kettle of fish, right? If we're talking about 3, 4, 5, 6 rate hikes, that's different. We're talking about 1 or 2. I mean, it's a rounding error in the grand scheme of things. It is the idea of a new cycle that I think could be quite disruptive.
Right, which means the outcome is probably 0 or 3.
I think that's right. I think it's unlikely that the Fed would embark on, with a couple of caveats, I think it is unlikely that the Fed would embark on a sequence of, would embark into raising rates without thinking that they're going to have to do several. Like if you think you only have to do 1, it's probably not worth doing. The only exception to that, or the main exception to that, is that we do have a new Fed chair, Kevin Warsh. There are questions about his independence given the administration's efforts to influence the Fed. It is possible that he might conclude, and there are members of the committee who might conclude, that it's worth raising rates once or maybe even twice just to demonstrate independence. So that's a scenario we wouldn't want to rule out. The Fed would certainly not describe it that way if they were to raise rates. They would not say we're doing this to stick our finger in the eye of the administration. That's not a clever thing to do ever, but especially with this administration. But it is possible that they might be more willing to do 1 or 2 hikes than they otherwise would. But in general, Scott, I think you're right. If you think you only have to raise rates once, you probably shouldn't bother.
I'd say the only thing that jumps out here as I look to the left and right of the table and I see Scott and Matt, we're getting into fixed income in a little while, is the market and what it is baked into actual rates in terms of expectations for inflation. If those get taken out, what that means to actual levels of rates and what we can do from a market perspective. Okay, so let's keep ourselves moving. Let's put it all together real quick.
There's our forecasts. They're boring. There isn't very much of a change in anything relative to where we were at the beginning of the year, other than inflation being higher. I struggle to say anything particularly interesting about them. Growth is around 2%. We expect it to be around 2%. If I had to forecast 2028, I'd put it around 2%. We think that longer dated interest rates, 10-year rates, are roughly fair where they are. It's a recipe for more of the same.